Imagine a company that turns every single dollar of invested capital into a return of 176%, and yet its stock has still dropped almost 25% in the past year. Sounds impossible, right? Well, that's exactly what's happening with Veeva Systems right now, and by the end of this video, you'll understand exactly why. Let's start with the number that should stop you in your tracks: Return on Invested Capital, or ROIC. This measures how efficiently a company turns the money it has invested from both debt and equity into actual profit. Most companies would be thrilled with a ROIC of 15% or 20%. Veeva Systems is sitting at 176.94%. That's not a typo, but here's where things get interesting. If the business is performing this well, why has the stock lost almost a quarter of its value over the last 52 weeks? To answer that, we need to look deeper. Because on paper, this company looks incredibly strong. In the last 12 months, Veeva brought in $3.32 billion in revenue, and it kept a massive chunk of that as profit, $941.65 million to be exact. That works out to earnings per share of $5.64. Revenue is also growing at a rate of 16.25% over the past year, meaning more sales are consistently flowing into the business, not shrinking. Now here's something that might surprise you. Out of every dollar Veeva makes in revenue, about 75 cents remain after covering the direct cost of delivering its product. That's called the gross margin, and 75.02% is an extremely high number for any industry. After all expenses, including overhead and operations, the company still keeps 29.72% as operating profit, and 28.37% ends up as pure net profit margin. In simple terms, for every $100 a customer pays Veeva, roughly $28 becomes actual profit. That's an efficiency level most businesses can only dream of. But here's where investors often get confused. A company can have amazing margins and still not be considered cheap by the stock market. Veeva currently trades at a price-to-earnings ratio, or PE ratio, of 37.57. This tells you investors are paying $37.57 for every $1 of current earnings. At first glance, that sounds expensive, but here's the twist. The forward PE based on expected future earnings drops to 22.94. That's a big difference, and it suggests the market expects earnings to keep climbing. There's also the PEG ratio, which adjusts the PE ratio based on growth. Veeva's PEG ratio sits at 1.07, generally considered close to fair value once growth is factored in. And that's not even the most surprising part. Let's talk about debt. Veeva has a debt-to-equity ratio of just 0.01. That means the company runs almost entirely without borrowed money. To put that in perspective, Veeva holds $7.31 billion in cash and cash equivalents while carrying only $103.07 million in total debt. That leaves a net cash position of $7.21 billion, or $44.38 in cash, sitting behind every single share. This is one of the cleanest balance sheets you'll come across. Very little financial risk and a massive cushion if things ever slow down. So if the company is this financially strong, generating $1.64 billion in free cash flow, the actual cash left over after running the business and spending on equipment, with a free cash flow margin of 49.42%. Why isn't the stock price reflecting that strength? This is where the story gets a little more layered. The stock's 50-day moving average sits at $179.96, while the 200-day moving average is higher at $203.08. When the shorter-term average sits below the longer-term one, it often reflects recent price weakness compared to where the stock has traded over time. Meanwhile, the beta, which measures how much a stock moves compared to the overall market, is 0.94, meaning Veeva has historically moved almost in line with the broader market, not wildly, more or less. However, one number changes the picture even further. Short interest, the portion of shares investors have bet against expecting the price to fall, sits at 4.87% of shares outstanding. It's not an extreme number, but it does show that some investors remain skeptical, even while the fundamentals look strong. Meanwhile, institutions own 87.77% of the company, showing that large investors still hold a significant stake in the business. Now here's something most casual investors completely overlook. Veeva has an Altman Z-score of 15.38. This score is used to estimate how likely a company is to face financial distress or bankruptcy. Anything above 3 is generally considered a safe zone. Veeva's score isn't just above that line, it's dramatically above it, suggesting extremely low financial distress risk. On the other hand, its Piotroski F-score, which evaluates a company's financial strength across 9 different tests, sits right in the middle at 5. That tells a more balanced story, solid but not flashing every single positive signal at once. So the real question isn't just whether Veeva Systems is a strong business. The numbers already show that it is. The real question is this: will the market eventually catch up to what the fundamentals are already showing? Or is there something the current stock price already knows that the balance sheet hasn't revealed yet? That's something only time will answer.